This is a special podcast presentation from 700WLW.com. This is Casey Boland on Demand.
Casey Boland joins me now with Hangold Capital Management. And Casey, something I've noticed in the past, when you talk about the weather, there's a difference between what's average and what's normal. And you would say the same thing is true about the stock market, would you not?
Yeah, I mean, that's a perfect parallel. I mean, average is not normal when you look at the stock market. During the last 87 years, the best year in the market was up 56%. The worst year, one we don't really want to talk about, but it was down 43%. But it's interesting, when you look at all those periods of time, 20 of the years, they were negative. So about 25% of the time, the market has had negative returns. But when you look at what percentage of the time is the market having a gain between 9% and 11%, which is right close to the 10% average of the stock market long term. Right. It's interesting, only 2 times out of the last 87 years has the average of the market lined up with what actually happens with the market.
Yeah, that's funny. Averages are much different. What today's average high might be, 82, but maybe in the last 87 years it's been 82 only 5 times. It's the same idea when we get into stocks.
You're exactly right. And so you look and say, well, why is this helpful to know? Well, I think the problem with averages is just kind of like the temperature, is that then people count on and say, well, if the market's averaged around 10%, but by gosh, I'm going to look and make sure that I get about 10% per year, and that's just not the expectation you should have. And yes, most of the time the market will go up, but the expectation of the market going up, you shouldn't have that every year. It's normal to have negative years. It's normal that the ride's going to be rough at times.